Because the market is falling so fast, now even the mutual funds are facing redemption pressure from individual investors. And because many of the stocks, especially on the smaller cap China export stocks, they have suspended trading. So when a mutual fund manager, they are facing redemption pressure, they have to liquidate some of the good companies that they have in their portfolio. And that is creating another wave of selling pressure in the market as well.
The concern that I have is that the fact that the Chinese authorities are intervening to the extent that they are suggests there's a much bigger problem in margin, over-margining, over-borrowing of stocks. They're trying to keep the stock market supported, and that's why we're seeing the heavy volatility that we've seen over the past few days.
What kind of signal is this sending? The central bank is effectively doing some form of QE. Instead of buying government bonds, it's artificially setting the price of shares and saying this particular company here, we believe it should be priced at this particular level. This is where the PE ratio is fair. And on an individual firm basis, is that 50, 60, 30, 20?
Yeah.
Some bureaucrat in a central bank is deciding. I don't call that market reforms. I call that the complete opposite.
It will have a negative impact on consumer spending, but don't forget that the Chinese have the capacity to reduce interest rates, which we don't have. They've kept their interest rates much higher than we've seen in the West. Their government budget deficit, their government budget position is in a much stronger position than we've got in the West. They have a balance of payments surplus still. So the fundamentals for the economy in terms of its imbalances and where it stands are much more positive than some of the other vulnerable economies that we're worried about.